There is a company that owns a piece of almost everything you have ever touched. The phone in your hand, the car in your driveway, the gas that fills it, the bank that holds your mortgage, the hospital where your children were born, the airline that flies you home for the holidays, the streaming service you fall asleep to at night. This company owns a share of all of it, and you have never voted for them. You have never elected a single person who works there. You have never been asked whether they should have this power. They simply took it, quietly, legally, and on a scale that no king, no emperor, no government in the history of civilization has ever achieved. The company is called BlackRock, and tonight we are going to tell you exactly what they own, exactly how they got it, and exactly what it means for the world you live in. By the time this story is over, you will understand something about the architecture of modern power that most people go their entire lives without seeing, and then you will sleep. But you will sleep differently. Let us start with a number, $14 trillion. That is how much money BlackRock manages, 14 trillion. To understand how large that number is, consider this. The entire annual economic output of the United States, the richest country in the history of the world, is approximately $28 trillion. BlackRock manages half of that. The entire annual economic output of Japan is about 4 trillion. BlackRock manages more than 3 Japans. The entire annual economic output of Germany, France, and the United Kingdom combined is roughly $12 trillion. BlackRock manages more than all 3 of those nations put together. If BlackRock were a country, it would be the 3rd largest economy on Earth, behind only the United States and China, ahead of Japan, ahead of Germany, ahead of India, ahead of every other nation on the planet. But BlackRock is not a country. It has no citizens, it has no constitution, it holds no elections, it answers to no voters. It is a private company, headquartered in a glass tower in Midtown Manhattan, run by a single man who has held power for 37 years without ever facing a ballot. His name is Larry Fink, and this is his story. But more importantly, this is the story of what he built. Because what Larry Fink built did not just change finance, it changed the structure of power itself. It created a new kind of authority that the world has never seen before, an authority that is not military, not political, not religious. It is purely financial, and it is everywhere. The story begins with a failure, a spectacular, humiliating, career-ending failure. In 1986, Larry Fink was a rising star at First Boston, one of Wall Street's most prestigious investment banks. He worked in the mortgage securities division, where he had helped pioneer a new kind of financial product, the mortgage-backed security. These were bundles of home loans packaged together and sold to investors. The idea was simple. Thousands of homeowners pay their mortgages every month. Those payments create a steady stream of cash. Package those payments into a security, sell that security to investors, and everybody wins. The homeowner gets a loan, the bank gets a fee, the investor gets a return. But here is what most people do not understand about mortgage-backed securities, and why this detail matters so much for this story. When you buy a mortgage bond, you are betting on 2 things. First, you are betting that homeowners will keep paying their mortgages. Second, and this is critical, you are betting on interest rates. See, when interest rates change, everything changes. If you own a mortgage bond that pays 4%, and suddenly new mortgages are being issued at 6%, your old bond becomes less valuable. People do not want to buy your low-yielding bond when they can get a higher yield elsewhere. On the other hand, if interest rates fall from 4% to 2%, suddenly your bond is worth much more. Everyone wants it. The entire value of your bond depends on how interest rates move. This is called interest rate risk. Fink was brilliant at this. He understood the mathematics of risk better than almost anyone on Wall Street. He understood how to model cash flows and predict default rates and structure tranches so that different investors could take different levels of risk. He could look at thousands of mortgages and calculate what would happen to the value of bonds created from those mortgages under various interest rate scenarios. He was making First Boston enormous profits. He was 33 years old. He was on track to become one of the most powerful men on Wall Street. The partners were already discussing his name for partner track. His salary was climbing. His power was growing. His future was certain. And then interest rates moved in a way that broke his models. In 1986, Fink's department made a massive bet. They believed that interest rates would rise. So they positioned their portfolio accordingly. They shorted bonds. They bet against bonds. If interest rates went up, bonds would fall in value, and Fink would make an enormous profit. But interest rates did not go up. They fell. And as they fell, the bonds that Fink had bet against soared in value. Every single day his position lost more money. The magnitude of the error became clear slowly at first, then all at once. $100 million in a single quarter. A bet on interest rate movements went catastrophically wrong. The models that were supposed to predict how mortgage bonds would behave when interest rates changed turned out to be catastrophically, humiliatingly wrong. The losses were immediate and devastating. $100 million in 1986 currency. Adjusted for inflation, that is roughly $270 million today. In today's money, that is how bad it was. The loss was not just a number, it was a profession destroyed. It was a career ended before it had truly begun. Fink was not just demoted, he was shunned. On Wall Street, where success is worshipped, and failure is a contagion that spreads through reputation like a disease, Fink became radioactive. Nobody wanted to be associated with the man who had lost $100 million. Partnerships and deals that had seemed within his grasp evaporated. Phone calls stopped coming. Lunches were cancelled. His career at First Boston was over. At 33 years old, Fink was finished. The ascent to power that had seemed inevitable was terminated. He was humiliated. He was isolated. And he was unemployable. But here is where the story turns. Because that loss taught Larry Fink something that would become the foundation of the most powerful financial company in history. It taught him that risk is the only thing that matters. Not returns, not profits, not the size of the trade, not the amount of leverage, not the alpha you generated last quarter. Risk, understanding risk, measuring risk, controlling risk. If you can do that, if you can build a system that tells you exactly how much you stand to lose under every possible scenario, then you can never be surprised again. You can never lose $100 million in a quarter because you will see the danger coming long before it arrives. You will see the patterns forming. You will see the assumptions breaking down. You will understand what can go wrong before it happens. You will have visibility into failure before failure arrives. This was not the realization of an ego bruised by failure. This was a fundamental insight into the nature of financial systems themselves. In 1986, most financial institutions did not have sophisticated risk management systems. They had traders. They had rules of thumb. They had intuition. They had experience. But they did not have systems that could model the entire portfolio and show the firm in real time how much was at risk if things went wrong. That gap, that massive gap between what firms thought they knew about their risk and what they actually knew, that was the vulnerability that would make Larry Fink rich. That was the problem that would allow him to build an empire. That was the realization that would transform a spectacular failure into the foundation for unprecedented success. And that insight, born from failure and humiliation, and the kind of soul-crushing moment that only Wall Street can produce, is what Larry Fink used to build BlackRock. In 1988, just 2 years after his catastrophic loss, Fink gathered 7 partners: Robert Capito, Susan Wagner, Barbara Novick, Bennett Golub, Hugh Frater, Ralph Schlosstein, Keith Anderson, 8 people in a single room. No clients, no track record, no reputation, except for the reputation of the man who had lost $100 million at First Boston. They gathered in that room not because they were optimistic about making a quick fortune. They gathered because they understood something that almost nobody else in finance understood. They understood that the financial system was fragile. They understood that the models that firms were using to measure risk were inadequate. They understood that the algorithms that traders relied on were built on assumptions that would eventually break. And they understood that the firm that could solve this problem, the firm that could build systems to measure and manage risk better than anyone else, that firm would own the future of finance. That firm would become indispensable. That firm would grow into something unprecedented. They needed money to start. Fink went to Peter Peterson, the chairman of the Blackstone Group, a private equity firm. Peterson was impressed not by Fink's past success, but by his understanding of the problem he wanted to solve. Peterson understood that the future of finance belonged to those who could manage risk. Peterson gave Fink a $5 million credit line in exchange for a 50% stake in the new company's bond business. $5 million. That was the seed. $5 million that would grow into hundreds of billions of dollars of revenue per year. From $5 million in a single room with 8 people, BlackRock would grow into a $14 trillion colossus in less than 4 decades. $5 million became $50 billion, then $500 billion, then $1 trillion, then $14 trillion. The mathematics of exponential growth applied to an institution that nobody could afford to leave. The company's original name was Blackstone Financial Management. It operated under the Blackstone umbrella in Blackstone's offices, supported by Blackstone's infrastructure. But within a few years, Fink's operation had grown so fast and so independently that the relationship became strained. Blackstone wanted to expand into private equity. Fink wanted to stay focused on risk management systems and asset management. The two businesses wanted different things. They competed for the same people. They competed for the same focus. In 1992, the company was renamed BlackRock and became fully independent. Blackstone sold its stake, and what had been a small division of a private equity firm became its own entity, ready to reshape the world. The name was chosen carefully: Black for opacity, Rock for stability. The name itself was a statement of philosophy. We are solid, we are permanent, and you cannot see through us. It was the perfect name for what Fink wanted to build. It was a name that suggested both power and obscurity. From the beginning, BlackRock was different from every other firm on Wall Street. While other firms chased the biggest returns, BlackRock focused on risk management. While other firms hired traders who could make bold bets and win big or lose big, BlackRock hired mathematicians and computer scientists who could build systems to model risk. While other firms celebrated the deal, the 1,000-point move, the legendary trade, BlackRock celebrated the algorithm, the model, the system, the ability to see what others could not see, the ability to understand what others could not understand. It was not exciting. It was not glamorous. It was not the kind of firm that produced legends of Wall Street excess and cocaine-fueled deals that you read about in books and movies. But it was devastatingly effective, and it was building something that would eventually dwarf every other financial institution on Earth. And at the center of everything BlackRock built was a system, an artificial intelligence system that would become the most powerful financial technology ever created. A system so vast, so comprehensive, so deeply embedded in the global financial infrastructure that it now monitors more money than any government, any central bank, any institution on Earth. A system that would give BlackRock the ability to see around corners, to understand risks that other institutions did not even know existed, to know things about the global financial system that the Federal Reserve itself did not know. To have visibility into financial flows and vulnerabilities that were invisible to every other observer. The system is called Aladdin. That name should stay with you, because by the time you understand what Aladdin does, you will understand why BlackRock is not just a company, it is an infrastructure, a utility, a piece of the global financial plumbing that cannot be removed without breaking everything. It is embedded so deeply into the operations of global finance that removing it would be catastrophic. Aladdin stands for Asset, Liability, Debt and Derivative Investment Network. It was built in the early 1990s when BlackRock's team of mathematicians and programmers began developing proprietary risk models that could simulate thousands, then millions of possible futures. What would happen to a portfolio if interest rates rose 3%? What would happen if a sector crashed 40%? What would happen if a currency devalued overnight? What would happen if all of those things happened at the same time? What would happen if they happened in combination with a geopolitical crisis? What would happen if they happened while inflation spiraled out of control? What would happen if multiple crises hit simultaneously? What would happen if the assumptions about historical correlations turned out to be wrong? To answer these questions, Aladdin uses something called Monte Carlo simulation. That name comes from the famous casino. The idea is simple but profound. You cannot predict the future, no one can, but you can model the probability of different outcomes. You can say, based on historical patterns and market data and sophisticated mathematical models, here is what might happen, and here is what might happen instead. And here is what might happen if we are in the worst 1% scenario. And here is what might happen if everything goes wrong at once. The system runs millions of simulations, millions of possible versions of the future. It calculates what would happen to a portfolio in each of those futures. It tests each position against thousands of different market scenarios. It breaks down every possible way that a portfolio could lose money, and then it presents the results. It shows the portfolio manager the distribution of outcomes. It shows where the risks are concentrated. It shows which positions would hurt if this happens, and which positions would hurt if that happens. It shows the interaction between risks. It shows correlations breaking down. It shows cascading failures. It shows the kinds of events that happen once in 100 years, and what would happen if those events happened. Other firms had risk models, but Aladdin was different. Aladdin did not just model risk for BlackRock's own portfolios. It was designed from the beginning to be a platform, a service that could be sold to other institutions, pension funds, insurance companies, sovereign wealth funds, endowments, and eventually central banks, and eventually competitors. BlackRock would sell Aladdin to the very firms that competed with BlackRock. It was a stroke of genius. By selling Aladdin, BlackRock created a system where competitors depended on BlackRock's technology to run their own operations. This is the detail that changes everything. Pay attention. Aladdin is not just a tool. It is a system that its users become dependent on. Financial institutions that use Aladdin integrate it into their entire infrastructure. Their traders use it. Their risk managers use it. Their executives use it to make decisions about where to allocate capital. Their analysts use it to understand their portfolios. The system becomes embedded in the institution. It becomes the way that institution thinks about risk. It becomes the way that institution talks about its portfolio. It becomes the language that the institution speaks. It becomes indispensable. And once it becomes indispensable, it becomes impossible to remove. By 2020, Aladdin was monitoring $21.6 trillion in assets, not BlackRock's assets, total assets using Aladdin. By 2025, that number had grown to approximately $25 trillion. $25 trillion. That is nearly twice as much as BlackRock itself manages. Think about that for a moment. BlackRock manages $14 trillion of its own. But Aladdin watches over $25 trillion. That means Aladdin watches over money that does not belong to BlackRock. It watches over the portfolios of BlackRock's direct competitors, Vanguard, State Street, Fidelity. It watches their positions. It sees what they are buying. It sees what they are selling. It sees where they have concentrated risk. It sees their vulnerabilities. It watches over the reserves of central banks around the world. It watches over the pension funds that pay the retirement of hundreds of millions of people in 70 countries around the world. 70 countries, on every continent, in every time zone. The central banks that use Aladdin include the Federal Reserve, the European Central Bank, the Bank of England, and the central banks of Japan, Canada, Australia, Brazil, Mexico, South Korea, Singapore, and dozens of other nations. These are the institutions that control the money supply, that set interest rates, that shape the global economy, that respond to crises and recessions and panics, and they all use BlackRock's system to manage their reserves. They all rely on Aladdin to help them understand their risk. They all depend on BlackRock's technology to run their operations. Think about what that means. BlackRock has built a system that gives it a window into the investment strategies, the risk positions, the vulnerabilities, and the plans of virtually every major financial institution on Earth. When a central bank adjusts its reserves, Aladdin sees it. When a pension fund shifts its allocation, Aladdin sees it. When a competitor makes a large trade, Aladdin sees it. Sometimes Aladdin sees it before the order even goes through to the market. Sometimes the systems that use Aladdin are running simulations asking what-if scenarios, stress testing different outcomes, modeling the impact of policy changes, and BlackRock's system records all of it. The information asymmetry is staggering. It is not just asymmetry, it is an abyss. BlackRock can see the global financial system from a vantage point that no other institution can match. BlackRock knows things that governments do not know. BlackRock has visibility into global capital flows that central banks cannot match. Aladdin also provides something else. It provides stress testing. When a financial institution uses Aladdin, it can ask the system, what happens to my portfolio if interest rates spike? What happens if the stock market crashes 30%? What happens if a major bank fails? What happens if there is a geopolitical crisis? What happens if all these things happen at once? Aladdin runs the simulations and shows the results. But here is the thing that matters. When Aladdin runs these stress tests, BlackRock sees the results. BlackRock knows which scenarios concern which institutions. BlackRock knows which institutions are vulnerable to interest rate rises. BlackRock knows which institutions have concentrated risk. BlackRock knows what would happen if the system broke. This is not speculation. This is not guesswork. This is data. This is visibility into the inner workings of global finance that has never been centralized in a single private company before. BlackRock is watching. Aladdin is watching. $25 trillion is being monitored by a system that BlackRock built and controls. BlackRock is not just managing money, it is watching the money, all of it, in 70 countries, in real time, through a single system that it built and controls, a system that runs analysis on all of it simultaneously, that understands the risks in all of it simultaneously, that sees the global financial system as one integrated whole rather than as separate institutions. And the institutions that use Aladdin cannot easily leave. This is the trap. The switching costs are so high that leaving would be like a hospital, switching to a different electronic medical record system. Theoretically possible, practically catastrophic. The financial institution would have to migrate years of data. They would have to retrain their entire operation on a new system. They would have to reprogram their trading systems. They would have to change the way their traders think about risk. They would have to rebuild relationships with the system that has become embedded in their operations. So they do not leave. They stay locked in. They become dependent. Some of the largest financial institutions in the world are trapped using BlackRock's system. They cannot switch because switching would be more disruptive than staying. The cost of leaving is higher than the risk of depending on a competitor. This is what economists call a lock-in effect. Once you have integrated Aladdin into your operations, you cannot leave without destroying your operations. You are locked in, permanently. Your firm will never use a different risk management system. You will never know what it feels like to not depend on Aladdin. Your traders will retire having never used anything else. Your analysts will spend their entire careers relying on Aladdin. And all the while, BlackRock watches. All the while, BlackRock collects information. All the while, BlackRock gains deeper understanding of your firm and your strategies and your vulnerabilities than you yourself may have. This is the first layer of BlackRock's power, not just the money it manages, the money it sees, the information it collects, the visibility it has into the entire global financial system through a single artificial intelligence platform that runs 24 hours a day, 7 days a week, in 70 countries, monitoring $25 trillion while most of the world sleeps. Aladdin sees more of the global financial system than any human being has ever seen. It sees more than the Federal Reserve can see. It sees more than the Treasury Department can see. It sees more than any regulator or government agency has access to. It sees a unified picture of global money flows and financial risks and vulnerabilities and interconnections that only BlackRock has access to. Remember that. It comes back. But there is a second layer. And this layer is what makes BlackRock truly unprecedented. This layer reveals a kind of power that did not exist before the late 20th century. This is the power of owning a piece of everything. BlackRock is the largest shareholder in almost every major corporation in America, through its index funds and ETFs, primarily through its iShares division, which manages $5.1 trillion in exchange-traded funds alone. BlackRock holds significant ownership stakes in the companies that define modern life, not small stakes, huge stakes, the largest stakes, Microsoft, $307 billion in BlackRock holdings, Apple, $292 billion, Amazon, $159 billion, JP Morgan Chase, $66 billion, ExxonMobil, Chevron, Pfizer, Johnson & Johnson, Walmart, Google, Meta, Bank of America, every major airline, American Airlines, Delta, United, Southwest, every major defense contractor, Lockheed Martin, Raytheon, Northrop Grumman, Raytheon Technologies, General Dynamics, every major pharmaceutical company, Eli Lilly, Merck, Moderna, AbbVie, every major tech company, Nvidia, Tesla, Intel, AMD Broadcom, every major bank, Goldman Sachs, Morgan Stanley, Wells Fargo, Citigroup, Bank of New York Mellon, every major energy company, Chevron, ConocoPhillips, EOG Resources, every major agricultural company, every major food company, every major consumer company, every major industrial company. BlackRock owns a piece of all of them, not a small piece, a major piece. Now here is the part that makes this more than just a story about a large investment fund. When BlackRock owns shares in these companies, it gets to vote those shares. Every year, public companies hold shareholder meetings where votes are cast on who sits on the board of directors, how much the CEO gets paid, whether the company merges with another company, whether the company pursues certain environmental policies, whether the company adopts certain labor practices, what the company's priorities are going to be. These votes determine the direction of the most powerful corporations on Earth, and BlackRock casts the votes. BlackRock casts approximately 1/4 of all votes at shareholder meetings in the S&P 500. Think about that. One company, casting 25% of the votes. In 88% of the 500 largest corporations in America, BlackRock is the single largest shareholder. Not one of the largest. The largest. Its holdings are bigger than the holdings of the second and third largest shareholders, combined in many cases. When a board seat is up for election, BlackRock's vote matters more than any other investor's vote. When executive compensation is voted on, BlackRock's vote can determine the outcome. When a company considers a major merger or strategic decision, BlackRock's vote is often the deciding vote. And BlackRock does not own these shares with its own money. It holds them on behalf of its clients, the pension funds, the retirement accounts, the 401k plans of ordinary workers who have no idea that their savings are being used to exert influence over corporate America. Your retirement money is in BlackRock's hands, your mother's retirement money, your grandmother's retirement money, the pensions of teachers and firefighters and police officers, the endowments of universities and foundations. All of it is sitting in BlackRock funds, and BlackRock uses it to vote on your behalf without ever asking you how to vote. It does not ask you whether you want them to support a particular board candidate. It does not ask you whether you want them to vote for or against environmental proposals. It does not ask you whether you want them to weigh in on executive compensation. It does not ask you what you think the CEO should be paid. It just votes. It makes the decision for you. And you have never been told that it was voting in your name. You have no idea. You have never elected Larry Fink. You have never voted for a single member of BlackRock's board. You have never been consulted about how your shares should be voted. And yet, through the mechanism of asset management, through index funds and ETFs that hold your retirement savings, BlackRock exercises more influence over corporate governance than any elected official in the United States. The president does not vote on who runs Apple. Congress does not vote on who runs Microsoft. The American people have no say in who sits on the boards of the companies that shape their lives, but BlackRock does, and it votes with money that belongs to hundreds of millions of ordinary people who have no idea this is happening, who have no idea that the largest shareholder in their retirement account is making decisions about corporate governance without their knowledge or consent. This is not a conspiracy. This is not something hidden in secret documents or discussed in back rooms. This is the structure. This is how the system works. This is how modern finance is designed, and it works this way because most people do not understand it. Most people do not know that their retirement savings are being managed by a company that uses those savings to vote on corporate policy. Most people do not know that three companies, BlackRock, Vanguard, and State Street, together control 25% of the voting shares in corporate America. Most people do not know that these three firms, collectively known as the Big Three, manage over $26 trillion and are the largest shareholders in 88% of the S&P 500. Let that number land. Let it settle in. $26 trillion, just three companies, and 88% of the largest corporations. These three companies together own more stock in corporate America than any king or emperor in human history ever owned anything. They collectively control voting rights to a larger portion of corporate America than the entire American middle class owns. The combined middle class of this country, with all their homes and savings and retirement accounts and stock holdings, owns less of corporate America than these three companies. To understand how unprecedented this is, consider Standard Oil. John D. Rockefeller's Standard Oil Company dominated the oil industry in the late 1800s and early 1900s. At its peak, Standard Oil controlled roughly 90% of oil refining in the United States. 90% of one industry, 90% of a single sector. This was considered such a threat to competition and free markets that in 1911, the Supreme Court ordered Standard Oil to be broken up. The court found that Standard Oil was exercising too much market power, it was anti-competitive, it was harmful to the free market and to consumers, and it needed to be dissolved into smaller companies so that competition could exist. But here is what the big three control: not 90% of one industry, 88% of the largest 500 corporations across all industries. They control voting rights to technology and finance and energy and healthcare and defense and transportation and agriculture and consumer goods and everything else. They have more control over more companies than Standard Oil ever had. Standard Oil was broken up for having too much power over one industry. The big three are larger than Standard Oil was in terms of market dominance, but nobody is talking about breaking them up. Nobody is talking about dissolving them into smaller companies, because they are not seen as a problem. They are seen as an inevitable consequence of index investing. They are seen as neutral actors. They are seen as passive managers who are just tracking the market. But there is nothing passive about voting. There is nothing neutral about controlling 25% of the votes at shareholder meetings. There is nothing passive about deciding which board members get elected at Apple and Microsoft and Johnson & Johnson. There is nothing passive about determining how much the CEO of JP Morgan Chase gets paid. There is nothing passive about voting on whether pharmaceutical companies should pursue certain research directions or whether energy companies should invest in renewables. Academic research is starting to document the concentrated power of the big three. Scholars at Cambridge's Business and Politics Journal have published research showing that the concentration of ownership in passive index funds managed by three firms creates hidden power dynamics that were not visible when corporate ownership was more dispersed. When there were thousands of shareholders all voting independently, no single shareholder had the power to shape corporate direction. Each shareholder was a voice in the chorus. But when three firms control 88% of S&P 500 companies, those three firms have power that is not visible in most corporate governance discussions. They have veto power. They have the ability to determine outcomes. They have the ability to reshape corporate policy at will. It is a hidden power. It operates in the background. Most corporate executives do not even seem fully aware of how much power has concentrated at the top with these three firms. Most boards think they are independent. Most CEOs think they have discretion. Most investors think they are making independent decisions. But when three firms control 88% of your stock, their vote matters more than anyone else's vote. Their interests matter more than anyone else's interests. Their influence shapes the decisions that get made. It is there. It is structural, it is systematic, and it is growing. Every year more money flows into index funds. Every year the big three grow larger. Every year their control of corporate America becomes more concentrated. But the voting power, which is extraordinary and unprecedented, is only the third layer of what makes BlackRock unprecedented. There is a fourth layer, and this layer is where the story stops being a story about corporate finance and starts being a story about the relationship between BlackRock and the United States government itself. In the last 15 years, something has changed fundamentally. BlackRock has stopped being merely one of the largest financial companies in the world. It has become something else. It has become a partner to the government. It has become an extension of the Federal Reserve. It has become the institution that the government calls when everything breaks. It has become indispensable to the functioning of the government itself. The first time this happened, the government probably did not even realize it was setting a precedent. It was 2008. The financial system was collapsing. Bear Stearns was going to fail. Lehman Brothers was going to fail. AIG was going to fail. The Federal Reserve was facing an unprecedented crisis, and they did not know how to manage it. They did not have the expertise. They did not have the infrastructure. They did not have the systems, and they did not have the people who understood what to do. So they called BlackRock. Bear Stearns had approximately 750,000 derivative contracts on its books. Mortgage-backed securities, asset-backed securities, collateralized debt obligations, credit default swaps. All of these were toxic. All of them were falling in value. All of them were trading at a fraction of what they were worth on the balance sheet. Nobody wanted to buy them. The markets for these securities had frozen. Prices had collapsed. The Federal Reserve Bank of New York created a special purpose vehicle called Maiden Lane LLC to purchase these assets. The Fed extended credit of approximately $29 billion to purchase approximately $30 billion in assets. The assets on the books were worth roughly that amount, but nobody wanted to buy them at that price. So the Fed created a special structure to buy them, but the Fed could not do this itself. The Fed did not have the infrastructure. The Fed did not have the people with expertise in valuing mortgage-backed securities and asset-backed securities and the thousands of other complex instruments, the Fed did not have the systems to do the analysis. The Fed turned to BlackRock, and BlackRock had exactly what the Fed needed. BlackRock had the people, BlackRock had the systems, BlackRock had Aladdin. BlackRock had experience valuing these exact securities because BlackRock had been managing portfolios of them for clients. BlackRock received special authorization to conduct a comprehensive valuation and liquidation of Bear Stearns' toxic assets. BlackRock became essentially the director of final act for the Federal Reserve. The firm that had been founded on risk management principles was now applying those principles to manage the largest financial crisis in 80 years, and it worked. BlackRock helped the Fed unwind Bear Stearns without destroying the entire financial system. The process of liquidating $30 billion in toxic assets without crashing the market is not trivial. It requires skill, it requires judgment, it requires systems. BlackRock had all of it. But then AIG came along, and AIG was worse, much worse. AIG had sold credit default swaps, essentially insurance on mortgage bonds, to virtually every major financial institution on Wall Street. AIG promised to pay out if mortgage bonds defaulted. When those mortgage bonds crashed in value, AIG faced margin calls it could not meet. Margin calls of billions of dollars. AIG was about to fail, and when AIG failed, it was going to take down every major bank with it. The entire financial system was about to collapse because of one insurance company. On September 16, 2008, the Federal Reserve extended an $85 billion credit line to AIG, acquiring a 79.9% equity stake. The Fed effectively nationalized AIG. Again, the Fed turned to BlackRock to help manage the unwinding of AIG's massive portfolio of toxic assets. BlackRock had to value and help liquidate instruments that nobody else wanted to touch. BlackRock had to find buyers for things that seemed unsellable, and BlackRock did it. This was the critical moment. For the first time, the Federal Reserve had to admit that it needed a private firm to manage the government's response to a financial crisis. This created a precedent that has never been reconsidered. When the financial system breaks, the Fed calls BlackRock. The Fed does not call an academic expert. The Fed does not call a different firm. The Fed calls BlackRock. Because BlackRock has the expertise, BlackRock has the systems, BlackRock has Aladdin. This was not a temporary arrangement. This was not something that would happen once in a lifetime and never again. This was the beginning of a much deeper relationship, a relationship that would become clearer when the next crisis came. 12 years later, in 2020, the COVID-19 pandemic devastated financial markets. Within days, the stock market crashed. Within weeks, the decline became severe, credit markets seized up, companies could not borrow, the credit system was freezing, the economy was collapsing in slow motion, and again, the Federal Reserve faced a crisis it did not know how to manage. They did not know how to unfreeze credit markets. They did not know what to buy. They did not know how much to pay. And again, they called BlackRock. In March 2020, the Federal Reserve announced it would hire BlackRock to manage 3 major bond buying programs. The primary market corporate credit facility, where the Fed would buy new corporate bonds directly from corporations. The secondary market corporate credit facility, where the Fed would buy existing corporate bonds in the secondary market. The mortgage-backed securities program, where the Fed would purchase commercial real estate bonds. BlackRock was charged with directing as much as $750 billion into the corporate debt market for the Fed. $750 billion. That is not a small amount. That is not a sideline operation. That is a central role in government monetary policy. This was extraordinary. BlackRock was not just advising the Fed, it was making real-time decisions about which bonds to buy, how much to pay, and how to execute massive purchases in a destabilized market. The firm was acting as an arm of the United States government. The Federal Reserve was essentially outsourcing its monetary policy to a private company. The most important financial decisions the government was making were being made by BlackRock. But there was a problem, and this problem reveals the true nature of BlackRock's power. BlackRock was simultaneously doing 4 different things. First, it was managing the Fed's bond purchases, which gave it information about what the Fed was going to buy. If you know that the Fed is going to buy $100 billion in corporate bonds, you know that bond prices are going to rise. You know that corporate debt is going to become cheaper to issue. You know the impact on markets. Second, it was operating its own corporate bond ETFs, which benefited immensely from the Fed's buying. because the Fed was driving up the price of corporate bonds. Third, it was the largest shareholder in many of the companies whose bonds the Fed was buying, so it benefited through stock ownership when the Fed stabilized the corporate debt market. When the Fed buys bonds, stock prices go up. Stock. Fourth, it had Aladdin running simulations and stress tests, which meant it knew the impact of the Fed's policies on the global financial system before the Fed fully understood those impacts. It knew what would happen. It could position itself accordingly. BlackRock pledged to forgo profits from the Fed's program, earning no more than $7.75 million per year for managing the bond portfolio. That sounds like a lot. But during the Fed's 2020 quantitative easing program, BlackRock's corporate bond ETF received $4.3 billion in new investment. Think about that. $4.3 billion in new money flowing into BlackRock's fund. Vanguard's corporate bond ETF received $33 million. State Street's received $15 million. BlackRock's ETF received 130 times more money than its nearest competitor. Why? Because investors knew that the Fed was buying corporate bonds, and they wanted to buy corporate bonds too. And when they went to buy corporate bonds, they saw BlackRock's ETFs front and center, so they bought those. And as more investors poured money into BlackRock's corporate bond ETFs, the price of those ETFs went up. And everyone who held those ETFs made money. Everyone in those funds made money while the Fed was supporting the market, while BlackRock was managing the Fed's purchases. Progressive advocacy groups immediately raised alarm about what they called conflicts of interest abound. How can a firm manage government purchases fairly when it stands to profit from those purchases through its own funds and holdings? How can BlackRock advise the Fed on what bonds to buy when BlackRock owns the bonds and operates ETFs that own the bonds and hold shares in the companies whose bonds it is buying? How can there not be a conflict of interest? These are the right questions, but they were never answered. The Federal Reserve did not see a problem. The Treasury Department did not see a problem. Congress did not investigate, and BlackRock continued to manage Fed operations while profiting from those operations. Nobody stopped it. Nobody said no. It just continued. After 2008 and 2020, a pattern was clear, crystal clear. During crises, the Federal Reserve and Treasury Department would contract with BlackRock. They would turn to BlackRock. BlackRock became the default choice. This meant several things. BlackRock developed irreplaceable expertise in crisis management. No other private firm had done what BlackRock had done. No other firm understood how to manage the kind of toxic assets and market disruptions that the Fed faced. The Fed became dependent on BlackRock's capabilities. The Fed literally could not imagine managing a financial crisis without BlackRock. When the next crisis came, who would they call? BlackRock. When the crisis after that came, who would they call? BlackRock. BlackRock gained inside information about government policy. When you are managing the Fed's bond purchases, you know what the Fed is going to do before the market knows. You know what prices are going to be supported. You can position yourself accordingly. And BlackRock's influence over financial markets became intertwined with government authority. When the Fed and BlackRock worked together, their interests aligned. When the Fed bought bonds that BlackRock owned, everyone benefited. When the Fed's actions drove up the value of assets in BlackRock's funds, everyone in those funds benefited. A symbiotic relationship developed. The line between the Federal Reserve and BlackRock blurred. Where did one end and the other begin? It was no longer clear. This is the foundation for something that would emerge more clearly in later years. But for now, in Part 1, we have laid out the architecture of BlackRock's power. The $14 trillion, the Aladdin system that watches $25 trillion, the voting rights over 88% of the S&P 500, the Big Three's control over $26 trillion, and the beginning of the relationship with the Federal Reserve. We have shown you how a man who lost $100 million built an empire, how he turned failure into insight, how he built a system that became indispensable to global finance, how he created a company that the government cannot function without. But all of this, remember it, all of this is just the visible part, the money you can see, the stocks you can track, the votes you can count, the numbers you can read in financial disclosures and head EC filings and quarterly reports. What happened in 2008 and 2020, when the system broke, when it became clear that BlackRock was indispensable to government policy, reveals something far more disturbing about BlackRock's relationship with the United States government. It reveals a relationship that goes deeper than mere dependency. It reveals something about how power actually works in the modern world. It reveals the true nature of the merger between private finance and government authority. And that is what we will explore in part 2. For now, in the dark, in this moment before sleep takes you, hold on to this thought. BlackRock owns a piece of everything, and the government depends on BlackRock to manage the consequences when the system breaks. That is the relationship. That is the architecture. That is the power structure that rules your world, and you were not asked about it. You were never consulted, and you will never vote on it, but you will live with it every day, for the rest of your life. Now close your eyes. You know what happened in March 2008? The financial world didn't just crack. It shattered. It didn't fall slowly. It fell like a stone. Bear Stearns, one of the oldest investment banks in America, a firm that had survived the Great Depression, the stagflation of the 70s, the crash of 1987, collapsed in a single weekend. The firm had been around since 1923. 85 years. Accumulated wealth. Accumulated power. Accumulated trust. Gone. The weekend it fell was March 14th, 2008. By that Monday, the institution had been sold off to JP Chase. By that Tuesday, it was being dismantled. By that week's end, the oldest investment bank in America had ceased to exist. But when Bear Stearns fell, it didn't fall alone. It took with it approximately 750,000 derivative contracts. Let that number sit for a moment. 750,000. That's not contracts. That's individual financial instruments, separate agreements, each one connected to hundreds of other instruments through networks of obligation so complex that nobody, absolutely nobody, could see the full picture. These weren't simple stock trades. These were the most complex financial instruments ever invented. Asset-backed securities, mortgage-backed securities, collateralized debt obligations, CDOs, the so-called AAA-rated bonds that turned out to contain the most toxic debt in the financial system. $300 million of mortgage bonds that were never going to be paid, and then 300 million more, and then 300 million more. Layer upon layer upon layer of bad debt, disguised as safe investments, bundled into securities and sold to banks all over the world. $30 billion. That was the total value of what Bear Stearns had on its books. $30 billion of stuff that nobody wanted. Absolutely nobody wanted it. The market for mortgage-backed securities had frozen completely. Prices had crashed 70%, 80%, sometimes more. Banks were walking away from their own properties. Mortgages were underwater. Credit was gone. And the Federal Reserve had a problem that was almost impossible to comprehend. These assets didn't just represent lost money. They represented lost confidence. When a major bank fails and its assets are written down dramatically, it sends a signal through the entire financial system. If Bear Stearns' mortgage securities were worth 70% less than anyone thought, what does that mean for the mortgage securities at JP Morgan? What does it mean for the mortgage securities at Bank of America? What does it mean for the mortgage securities held by pension funds and insurance companies and retirement accounts across the United States? It means everything is worth less. It means banks don't trust each other. It means the entire credit system seizes up. It means the financial system stops functioning. The Federal Reserve couldn't let that happen. The central bank had to act, so it did something it had never done before. It created a special purpose vehicle called Maiden Lane LLC. This was not a real company. It had no employees. It had no office. It was a legal entity, a shell, created by the Federal Reserve for one purpose: to buy the toxic assets that nobody else would buy. The Federal Reserve extended credit of approximately $29 billion to Maiden Lane. That money would be used to purchase approximately $30 billion in assets from Bear Stearns. The Fed would lend the money. Maiden Lane would buy the junk. And then, somehow, the junk would have to be sold or liquidated or converted back into something resembling value. But here's the problem the Federal Reserve faced. The Fed didn't have the staff to do this. The Federal Reserve is not set up to manage hundreds of thousands of individual securities. It's not set up to value toxic assets or to figure out which parts of which securities might retain value. It's not set up to hire armies of traders and analysts and risk managers to look at mortgage pools and underwriting standards and determine what rate of default to expect. The Federal Reserve is the central bank of the United States. It controls monetary policy. It supervises banks. It lends money at crisis rates, but it doesn't manage individual portfolios of $30 billion in illiquid assets. Someone had to do it, though. Someone had to figure out what the assets were worth. Someone had to decide which ones might recover value and which ones were total losses. Someone had to navigate the unprecedented complexity of liquidating hundreds of thousands of derivative contracts that were all connected to each other through networks of obligation that nobody fully understood. The Federal Reserve looked around. Who had the expertise? Who had the systems? Who had spent their entire corporate existence thinking about exactly this problem? BlackRock. The Federal Reserve hired BlackRock to manage Maiden Lane LLC. BlackRock would be responsible for valuation. BlackRock would execute the liquidation. BlackRock would make thousands of individual decisions about what to do with hundreds of thousands of securities. BlackRock was essentially taking control of the Federal Reserve's response to the greatest financial crisis in 80 years. Stop and think about that moment. That is the moment the boundary between BlackRock and the United States government became infinitesimally thin. That is the moment a private company, a company that answered to shareholders, a company that could benefit from its own decisions, a company with profit incentives, became the operational arm of the Federal Reserve during the greatest financial crisis in modern history. This wasn't BlackRock serving as an advisor. This wasn't BlackRock being hired to provide information. BlackRock was hired to manage. BlackRock was hired to decide. BlackRock was hired to liquidate. BlackRock was acting as the Federal Reserve's fixer. And here's the thing that nobody talks about. Here's the thing that makes you understand the cosmic irony of the situation. The firm that was founded because Larry Fink had lost $100 million on mortgage bonds, a loss that had haunted him and shaped his entire philosophy about the importance of risk management, was now managing the cleanup of the greatest mortgage bond crisis in human history. The same type of loss that had motivated him to build a company devoted to understanding what could go wrong was now the type of loss that BlackRock was hired to manage on the largest possible scale. You can't make this up. The universe sometimes has a sense of irony that even screenwriters would reject as too obvious. But the Bear Stearns cleanup was just the beginning. It was the appetizer before the main course. In September 2008, just months later, another device detonated. Bigger than Bear Stearns, bigger than anything most people had ever imagined. AIG was an insurance company, the American International Group. It was massive. It was global. It was one of the largest corporations in the world, and it had been around for decades. It had weathered numerous crises. It seemed solid. It seemed safe. But AIG had gotten into the derivatives business. The company had a division that sold credit default swaps. Credit default swaps are essentially insurance contracts on bonds. You pay AIG a premium every month, and if the bond defaults, if the company that issued the bond goes bankrupt and stops paying interest, AIG pays you the full value of the bond. It's supposed to be insurance. It's supposed to work like insurance. The problem is that AIG massively, catastrophically underestimated the risk. The company had sold hundreds of billions of dollars of insurance on mortgage bonds. Hundreds of billions. And when the mortgage market collapsed and all those mortgage bonds started to default, AIG suddenly faced claims that it couldn't possibly meet. It's the insurance company's worst nightmare. The insured event happens, the claims come in, and the company doesn't have the money to pay. AIG faced what's called margin calls. When a counterparty to a derivatives contract sees that they might not get paid, they demand immediate payment to cover the risk. Hundreds of millions of dollars, billions of dollars, all at once. AIG couldn't meet the calls. The company was insolvent. It was going to fail. And if AIG failed, it would trigger a cascade of failures across the entire financial system. AIG had sold insurance to essentially every major financial institution in the world. Banks, insurance companies, pension funds, endowments. If AIG defaulted on that insurance, all of them would suffer massive losses. Some of them would become insolvent themselves. The system would break apart. So on September 16th, 2008, exactly 1 week after Lehman Brothers failed, the Federal Reserve did something unprecedented. It extended an $85 billion credit line to AIG, an $85 billion rescue. The government acquired a 79.9% stake in the company, effectively nationalizing it. It was the largest government seizure of a private corporation in American history, and nobody had time to ask whether it was constitutional or whether Congress should have approved it. The system was on fire. Something had to be done immediately, and once again the Federal Reserve faced the same problem it had faced with Bear Stearns. How do you manage the unwinding of a massive insurance company's derivatives portfolio? How do you deal with hundreds of billions of dollars of insurance contracts that are being called and have to be paid? How do you figure out what to do with the underlying assets? And once again, the Federal Reserve turned to BlackRock. BlackRock had to value AIG's massive portfolio of mortgage-backed securities. BlackRock had to help determine which insurance contracts could be negotiated down and which had to be paid in full. BlackRock had to manage the liquidation of AIG's toxic assets. BlackRock had to help the Federal Reserve figure out how to stabilize the system without letting AIG's collapse trigger additional cascading failures. So now the pattern was becoming clear. In 2008, during the greatest financial crisis in 80 years, the Federal Reserve had hired BlackRock twice, for two separate crisis situations, for two separate toxic asset portfolios. BlackRock had become the central bank's fixer. This is the precedent. This is how the system now works. When the financial system breaks, when there is genuine systemic risk, when the entire credit system is in danger of seizing up, the Federal Reserve does not rely on a government agency. It does not trust its own staff. It calls BlackRock. Why? Because BlackRock is the only firm in America that has both the technical expertise and the necessary systems to manage this kind of crisis on this kind of scale. BlackRock has Aladdin. Aladdin can look at hundreds of thousands of financial instruments and understand them simultaneously. Aladdin can run scenario analyses. Aladdin can determine what happens to a portfolio if mortgage default rates jump to 15% or 20% or 25%. Aladdin can decompose risk. Aladdin can understand which instruments are worth saving and which are worth letting go. No other firm has this capability. No government agency has this capability. BlackRock is unique. But here's what should make you uncomfortable about this entire arrangement. Here's the thing that nobody seems to talk about in the financial press, but that should be the most important question. When the Federal Reserve hires a private company to make decisions about which institutions survive and which fail, when it hires a private company to determine the fate of trillions of dollars in assets, when it hires a private company to effectively guide how the central bank responds to a financial crisis, that private company is not neutral. That private company has profit incentives. That private company has shareholders. That private company benefits when certain institutions survive and others don't. That private company can influence which assets recover value and which become worthless. This is not to say that BlackRock would deliberately sabotage one firm to benefit another. BlackRock is a professional institution. Its people are bound by regulations and fiduciary duties. The contracts with the Federal Reserve no doubt contain strict prohibitions against self-dealing. But there are subtle ways in which conflicts of interest can emerge, ways that are impossible to fully police, ways that arise naturally from the structure of the situation, and the Federal Reserve accepted all of this. The Fed accepted that it needed to rely on a private company. The Fed accepted that the private company would benefit from the crisis. The Fed accepted that the private company would gain access to information about the government's plans and strategies. The Fed accepted all of it because it had no choice. This is how crises concentrate power. This is how emergency situations lead to precedents that persist long after the emergency ends. This is how a private company becomes indispensable to the government. The 2008 crisis was eventually resolved. The financial system stabilized. Maiden Lane eventually paid back most of the Fed's emergency loan. Unemployment fell. The stock market recovered. And the crisis receded into history. BlackRock's role faded from the headlines, and everyone went back to their lives mostly unaware of what had just happened. But BlackRock remembered. The Federal Reserve remembered. And a precedent had been set. The precedent was simple. When things get really bad, the Fed calls BlackRock. And then came 2020. March 2020. The pandemic hits the United States like an earthquake. First it was the passing toll, then it was the hospitals being overwhelmed, then it was the economic shutdown. Governors ordered businesses closed, schools closed, restaurants closed, factories closed. The entire economy basically turned off. This wasn't a normal recession. This wasn't a normal crisis. This was something the United States had never experienced in the modern era. The stock market responds immediately. Panic selling. Circuit breakers halt trading multiple times in a single week. The market drops 28% in 12 days. The fastest bear market in history. Decades of gains wiped out in 2 weeks. And then the bond market seizes. This is the real danger. This is where systemic risk actually emerges. The stock market can be volatile. The stock market can be irrational. But the stock market is not essential to the functioning of the economy. The bond market is essential. The bond market is where corporations borrow money to meet payroll. The bond market is where states and municipalities borrow money to fund schools and roads. The bond market is how the entire credit system functions. And in March 2020, the bond market stops functioning. Corporate bond spreads blow out. That means the difference between the interest rate a safe company has to pay and the interest rate a risky company has to pay goes crazy. Even the safest companies can't borrow. The credit market is seizing up. The financing system that keeps the American economy operating is grinding to a halt. The Federal Reserve recognizes what's happening. This is the moment that the central bank was designed to handle. This is the moment when the Fed has to prevent a financial system collapse. So Paul Powell, the Fed chair, announces something that has never been done before in the history of the Federal Reserve. The Federal Reserve will buy corporate bonds, not treasury bonds, not mortgage-backed securities, corporate bonds. The bonds issued by American corporations. The Federal Reserve will purchase them directly. The Fed will create a marketplace for corporate bonds when the private market has frozen. The Fed will step in as the buyer of last resort. This is not conventional monetary policy. This is not textbook central banking. This is crisis intervention on an unimaginable scale. The Federal Reserve is basically saying, we will enter the corporate debt market. We will buy up to $750 billion of corporate bonds. We will do whatever it takes to keep the credit system functioning. It's a powerful statement. It's an extraordinary commitment. It's exactly what the Federal Reserve is designed to do in moments of systemic crisis. But then the Federal Reserve makes a decision that will echo through the financial system for years to come. The Fed will hire someone to manage this bond purchase program. The Fed will hire someone to identify which bonds to buy, someone to execute the trades, someone to determine valuations, someone to make thousands of decisions about which corporate bonds the American central bank would purchase, with emergency money drawn from the central bank's balance sheet. The Federal Reserve hired BlackRock. Actually, the Fed ended up hiring BlackRock for not one program but 3 separate programs. The Primary Market Corporate Credit Facility, the PMCCF. This is where the Federal Reserve buys new bonds directly from corporations. When a corporation wants to issue new debt to raise cash, it can do so through this program, and the Fed will buy it. The Federal Reserve is essentially guaranteeing that corporations can borrow money. Then there's the Secondary Market Corporate Credit Facility, the SMCCF. This is where the Federal Reserve buys existing bonds in the open market, bonds that have already been issued and have been trading among investors. The Fed will buy these too. The Fed will purchase them from whoever currently owns them, driving up the price, creating a market where there was panic and freezing. And then there's the Commercial Mortgage-Backed Securities Program. Again, the Fed is purchasing existing instruments. 3 separate programs, all managed by BlackRock, all involving BlackRock deciding which bonds the Fed should buy, all involving BlackRock directing where emergency Federal Reserve money flows into the corporate debt market. $750 billion. Let that number settle in. That is approximately 1/5 of the entire annual budget of the United States federal government. That is more than the GDP of Germany. That is more than the GDP of the United Kingdom. That is more than the entire annual economic output of every country in the world except the United States and China. And BlackRock is making the purchasing decisions. BlackRock is not advising the Fed. BlackRock is not recommending bonds to the Fed. BlackRock is actively directing where $750 billion of emergency central bank money flows into the American financial system. The logistics of this are extraordinary. BlackRock has to decide, which corporate bonds should the Federal Reserve buy today? How many bonds of which companies? At what prices? What about the composition? How much in investment-grade bonds? How much in high yield? What about duration? How many short-term bonds versus long-term bonds? What about sector diversification? What about the order in which bonds are purchased? All of these decisions are consequential. Every decision about which bonds the Fed buys affects the price of other bonds. If the Fed starts buying a particular company's bonds, the price goes up, and the cost of borrowing for that company goes down. If the Fed doesn't buy a company's bonds, the price stays depressed, and the cost of borrowing stays high. So BlackRock is making decisions that determine whether certain companies can raise capital at reasonable rates, or whether they struggle to borrow at all. BlackRock is making decisions that determine which companies' stock prices go up and which go down. BlackRock is making decisions that affect millions of people's retirement accounts, their 401ks, their savings. And this is extraordinary. This is almost impossible to comprehend in the moment. This is the opposite of checks and balances. This is the opposite of separation of powers. This is concentrated decision-making authority over $750 billion of government emergency funds vested in a single private company. But wait, it gets worse. Much worse. Because here's what happened while BlackRock was managing the Federal Reserve's bond purchase programs. While BlackRock was directing $750 billion into the corporate debt market, while BlackRock was making thousands of decisions about which corporate bonds the central bank would purchase, BlackRock's own corporate bond ETF, the funds that BlackRock sells to ordinary investors, the funds that regular people with 401ks and IRAs can invest in, received $4.3 billion in new investment. $4.3 billion in a single period into BlackRock's own corporate bond funds. Let me say that again so you understand what you're hearing. While BlackRock was managing the Federal Reserve's bond purchase program, the program that was creating demand for corporate bonds, the program that was sending $750 billion into the corporate debt market, BlackRock's own corporate bond ETFs received $4.3 billion in new investment. Vanguard's corporate bond ETFs, by contrast, received $33 million. State Street's corporate bond ETFs received $15 million. BlackRock received $4.3 billion. That's not just more, that's catastrophically more. That's 130 times more than State Street. That's 130 times. Do you understand what you're looking at? Do you see the structure? BlackRock was simultaneously three different things. First, BlackRock was managing the Federal Reserve's bond purchase program. BlackRock had access to information about what the Fed was going to buy, when the Fed was going to buy, at what prices, what the Fed's strategy was, what bonds the Fed viewed as most important to stabilize the market. Second, BlackRock was running its own corporate bond ETFs, funds that ordinary investors invest their retirement money into. And these funds received massive inflows specifically because BlackRock's management of the Fed's bond purchase program was driving up corporate bond prices and creating demand for corporate bond investments. Third, BlackRock was the largest shareholder in many of the companies whose bonds the Federal Reserve was purchasing. So when the Fed bought bonds from, say, Apple or Microsoft or JP Morgan Chase, the price of those companies' bonds went up. And if the price of the bonds goes up, the price of the stock often follows. So BlackRock benefited as a shareholder, in addition to benefiting through its ETF inflows. 3 layers of conflict of interest. 3 separate ways that BlackRock benefited from its role managing the Federal Reserve's emergency bond purchases. And each benefit was perfectly legal. Each benefit was authorized. Each benefit was disclosed. And yet nobody, no regulator, no journalist, no politician, no government official, raised serious objections about any of this. This is the profound difference between corruption and structural conflict. Corruption is illegal. Corruption is a crime. Corruption involves someone breaking the rules. But what BlackRock did was not corrupt. It was perfectly legal. It was within the bounds of regulation. It was disclosed. It was authorized. And that's what makes it so dangerous, because corruption can be prosecuted. Corruption can be punished. But structural conflicts of interest that emerge naturally from the structure of how power is organized, those are almost impossible to address. They don't violate any laws. They don't break any regulations. They just exist. They're built into the system. BlackRock later pledged to forego profits from the Fed's emergency programs. The company said it would earn no more than $7.75 million per year for managing what was arguably the most important financial intervention in American history. Hundreds of billions of dollars of emergency central bank purchases managed for $7.75 million per year. That's less than some hedge fund managers make in a week. But the compensation wasn't the real issue. The real issue was the information, the position, the access to knowledge about what the Federal Reserve was going to do next, the ability to front-run those decisions through BlackRock's own funds, the ability to benefit from the Fed's purchases through BlackRock's shareholdings in the underlying companies. This is power, not crude power, not obvious power, but real power, structural power, the kind of power that shapes outcomes without anyone having to explicitly exercise it. Consider the implications for systemic risk. If BlackRock became insolvent tomorrow, if something happened to BlackRock that threatened its solvency, it would trigger a financial crisis. Because BlackRock manages so much money, because so many institutions depend on BlackRock's systems, because the Federal Reserve depends on BlackRock during crises. If BlackRock failed, it would be a blow to the entire financial system. But here's what makes it even worse. The Federal Reserve would have to rescue BlackRock, just like it has to rescue any systemically important financial institution. Because BlackRock is too important to fail, too central to the infrastructure of finance, too essential to how the government manages the financial system. And when the Federal Reserve rescues BlackRock, who would the Fed hire to manage that rescue? Who has the expertise? Who has the systems? Who could possibly manage a situation where the company that manages crises for the government has itself become a crisis? The answer is nobody. There is no other firm. There is no backup. There is no plan B. If BlackRock becomes a systemic risk, the system breaks. Because the system now depends completely on BlackRock. This is the ultimate concentration of power. This is financial too big to fail, taken to its logical conclusion. Not just too big to fail, but so essential to the functioning of government that failure is literally unthinkable. The system cannot continue without BlackRock, and BlackRock knows that. Executives at BlackRock understand that they have become indispensable to how the government works. What happened in the years between is important to understand, because it wasn't random, it wasn't accidental, it was systematic. In 2009, 2010, as the immediate crisis receded, BlackRock's role in the government response became less visible. The Maiden Lane facilities wound down slowly. The emergency programs ended. The crisis felt like it was over, and America turned its attention to recovery. But in those quiet years, something was happening that nobody was really paying attention to. BlackRock was consolidating its position. The firm acquired Barclays Global Investors in 2009. This gave BlackRock control of iShares, the world's largest ETF business. It was a transformative acquisition. BlackRock went from being a firm that managed money and provided risk analytics to being the dominant force in passive index investing. The firm that was founded to understand risk was now controlling how trillions of dollars flowed into index funds. And the government relationships didn't stop. They intensified. Government officials didn't stop joining BlackRock. BlackRock executives didn't stop joining government boards. The revolving door kept spinning. It just spun quieter. It got less media attention, but it kept spinning. The Fed learned to depend on BlackRock not just in crisis, but also in normal times. The Fed used BlackRock's Aladdin system to monitor its own portfolio. The Treasury Department used BlackRock's analytics. Central banks around the world started using BlackRock's systems to manage their reserves. Government became accustomed to relying on BlackRock. BlackRock became woven into the infrastructure of how government actually operates. So now let's look at the pattern. 2008. The financial system collapses. Bear Stearns fails. AIG fails. The credit market seizes. The Federal Reserve faces existential crisis. The Fed turns to BlackRock. BlackRock manages the cleanup. 2020. The pandemic crashes the economy. The stock market falls 28% in 2 weeks. The bond market seizes. The credit system freezes. The Federal Reserve faces existential crisis. The Fed turns to BlackRock. BlackRock manages the emergency bond purchases. This is not coincidence. This is not happenstance. This is a pattern that has now been reinforced twice in 12 years. The Federal Reserve has learned that it can depend on BlackRock, that BlackRock has the expertise, that BlackRock has the systems, that BlackRock can execute at scale that no other institution can match, that BlackRock is the only institution in the world that can do what needs to be done when everything is on fire. And in the process, BlackRock has become something other than what it was originally designed to be. It's no longer just an asset manager managing money for clients. It's now an arm of the government, a private arm, an unelected arm, an arm that answers to shareholders but also to the Federal Reserve, an institution that operates both inside the government and outside it simultaneously. Think about what Aladdin means in this context. Aladdin is BlackRock's artificial intelligence system. It monitors $25 trillion in assets globally. it's used by central banks, it's used by the Federal Reserve, it's used by the Treasury Department. When the Federal Reserve uses Aladdin to monitor and manage its own portfolio, that means BlackRock has real-time visibility into the Federal Reserve's financial position. BlackRock knows what the Fed owns. BlackRock knows what the Fed is considering buying or selling. BlackRock knows the Fed's strategy before the Fed even announces it. This is extraordinary. This means that a private company has insider visibility into central bank operations. A private company can see what the government is planning to do with its monetary policy tools before the government does it. BlackRock executives who sit on Treasury advisory boards have access to information about Treasury policy direction. They bring that information back to BlackRock. They use it to position the company's strategy. This was not the plan. This was not the original intention. But this is what happened. This is what has emerged from the structure of repeated crises and repeated reliance on BlackRock to manage those crises. This is what happens when you allow a private company to become so essential that government cannot function without it. And here's the terrifying part. Here's what should keep you awake at night thinking about the structure of the financial system. The next time there's a financial crisis, and there will be a next time because financial crises are as inevitable as economic cycles, the Federal Reserve will again call BlackRock. There is no alternative. No other firm has the capability. No other firm has the systems. No other firm has the expertise. The Federal Reserve will have to call BlackRock, and BlackRock will have even more power than it did in 2008. BlackRock will have even more access than it did in 2020. BlackRock will benefit even more than it did previously. BlackRock will become even more indispensable. This is the machine. This is how it works. Each crisis increases BlackRock's power. Each crisis makes the Fed more dependent on BlackRock. Each crisis increases BlackRock's opportunities to benefit from its own government relationships. But there's one more piece that ties all of this together. One more piece that explains how BlackRock went from being a risk management firm founded in a single room in 1988 to being effectively inseparable from the United States government. And that piece is people. The movement of people between BlackRock and the government. The revolving door. The revolving door exists in every industry. Executives move between industry and government. It's normal. It's part of how the system works. But at BlackRock, it's not normal. At BlackRock, it's systematic. It's accelerated. It's the defining characteristic of how BlackRock has woven itself into the structure of government power. Let's start with the Obama administration. Barack Hussein Obama was elected president in 2008, right in the middle of the financial crisis. He needed an economic team. He needed people who understood finance. People who understood the Federal Reserve. People who understood how to manage the greatest economic crisis since the Great Depression. And where did many of those people come from? BlackRock. BlackRock hired more than a dozen officials from the Obama administration. Not a few, not several, more than a dozen. This wasn't an occasional hire where a talented person went from government to the private sector. This was systematic. This was a recruitment campaign. BlackRock was deliberately hiring people from the highest levels of the Obama administration. The National Security Advisor, the person responsible for advising the president on matters of war and peace, an international crisis, the person with direct daily access to the president, joined BlackRock after leaving government. The Federal Reserve Vice Chairman, the person second in command at the Federal Reserve, appointed by Barack Obama himself, joined BlackRock. Treasury economists, Federal Reserve economists, White House economic advisors, senior advisors on climate and sustainability policy, deputy assistants to the president. They came from the Obama administration to BlackRock. Think about what that means for a moment. These are people who are intimate with the economic decision-making process. They shaped Obama's response to the 2008 financial crisis. They made decisions about how to handle the banks, how to manage the Federal Reserve, how to use government power to stabilize the financial system. They had access to information. They understood how government works. They had relationships with current officials. And then they moved to BlackRock. And when they got to BlackRock, they brought all of that knowledge with them. Relationships with people still in government. Understanding of how the Federal Reserve thinks. Knowledge of the internal debates within the Treasury Department. Insight into what matters to policymakers. The kind of knowledge that a private company would pay enormous amounts of money to obtain. This is valuable. This is incredibly valuable. This is the kind of insider knowledge that can shape how a company approaches government relations, how it positions itself, how it wins contracts, how it influences policy. But it also works in the other direction. Going the other way from BlackRock to government. BlackRock executives serve on government advisory committees, on Treasury advisory boards, on Federal Reserve advisory panels. Rick Reeder, a senior BlackRock executive and chief investment officer of BlackRock Fixed Income, serves on the Treasury's Borrowing Committee. This committee advises the Treasury Department on how to manage US government debt, how much to borrow, at what rates, what maturity structure to use. These are crucial decisions about the finances of the entire country, and Rick Reeder also sits on the Federal Reserve's Investment Advisory Committee, the same person, advising both the Treasury and the Federal Reserve simultaneously. Think about what information flows there. What does Rick Reeder know? What does the Treasury tell him? What does the Federal Reserve discuss with him? What information is shared in these advisory meetings? And what does he take back to BlackRock? This is the revolving door. This is how it works. A person sits on government advisory boards. That person learns things about government plans. That person goes back to BlackRock and shares that information. BlackRock uses that information to position itself, to anticipate government actions, to benefit from government decisions. And it's not just limited to the United States. It's global. BlackRock has recruited people from governments around the world. Philip Hildebrand is the vice chairman of BlackRock. He's not an advisor. He's not a consultant. He's the vice chairman, the second highest position in the company. And who was Philip Hildebrand before he joined BlackRock? He was the head of Switzerland's central bank, the Swiss National Bank. He ran the entire central banking system for one of the most important financial centres in the world, and now he's vice chairman of BlackRock. George Osborne was the Chancellor of the Exchequer of the United Kingdom, the person in charge of British government finances, the person who shaped UK fiscal policy during and after the 2008 financial crisis, and now George Osborne is a senior advisor to BlackRock. Friedrich Merz was a senior politician in Germany. He served in the German parliament. He was involved in the highest levels of German politics and government. And before he entered German national politics, Friedrich Merz was the chairman of BlackRock Deutschland, BlackRock's German subsidiary. The pattern is unmistakable. The boundary between BlackRock and government does not exist. It is not blurred. It does not exist. It has dissolved completely. People move between BlackRock and government so fluidly, so frequently, that you can't tell where one ends and the other begins. And all of this flows through one person, one individual who sits at the centre of this web of power and government relationships. That person is Larry Fink. Larry Fink has transcended the normal boundaries of political influence. He is not locked into one political party. He is not constrained by the normal rules of partisan politics. He is not limited by the normal restrictions that limit most business leaders. In the early 2000s, Larry Fink was close to Democratic politics. He supported Hillary Clinton's presidential campaign in 2016. He attended fundraisers for Barack Obama. He contributed to Joe Biden's 2020 campaign. There were serious discussions, real, substantive discussions in political circles and media about making Larry Fink the Treasury Secretary of the United States. The Treasury Secretary. The person who runs the entire federal financial system. That was being discussed. That was a real possibility. But Larry Fink is not only close to Democrats. Something extraordinary happened in 2024 and 2025. Larry Fink became unexpectedly close to Donald Trump, Trump's inner circle, the president who was supposed to be skeptical of Wall Street, skeptical of the financial establishment, skeptical of the very institutions that BlackRock represents. And yet Larry Fink found himself in the president's inner circle, close to the president, advising on major financial decisions, part of the president's trusted advisors. This is remarkable. This is almost impossible to imagine for any other business leader. To be trusted by both Democratic and Republican administrations, to be relied upon by both, to move from the Obama inner circle to Trump's inner circle without losing influence, without being politically damaged, without becoming radioactive to either party. Why? Why does this happen? Why is Larry Fink seemingly immune to partisan politics? Because both administrations need BlackRock. Both sides need Larry Fink, because BlackRock manages $14 trillion. $14 trillion. You cannot run the United States government without cooperating with the person who controls $14 trillion. You cannot ignore them. You cannot alienate them. You cannot afford to have them as an enemy. So both administrations cooperate. Both administrations bring BlackRock into the inner circle. Both administrations seek Larry Fink's advice. Both administrations benefit from having someone who understands government and understands finance simultaneously. This is what unprecedented power looks like. This is what it means to be too important to ignore. This is what it means to have transcended normal political boundaries. Larry Fink has become something unique in American life. He is not elected. He has never run for office. He will never be elected to anything. But he has more influence over the direction of the American financial system than almost any elected official. More influence than most senators. More influence than most cabinet members. More influence than the leaders of most agencies. This is the consolidation of power. This is what it looks like when financial might becomes political might. This is what happens when a private company becomes inseparable from the government. And the mechanism is BlackRock. The system is BlackRock. The tool through which all of this power is exercised is BlackRock. Think about the scale. Think about what $14 trillion means. That is 50% of US GDP. That is 4 times the market capitalization of all S&P 500 companies combined. That is more than the total annual federal government budget multiplied by 4. That is more wealth than exists in most countries. With $14 trillion under management, you can buy influence. You can hire former government officials. You can put your executives on advisory boards. You can shape policy. You can determine which bonds the Federal Reserve buys. You can decide which companies survive and which fail. You can influence presidential elections by choosing to invest in certain sectors and not others. You can shift the direction of capital flows in ways that benefit certain politicians and hurt others. $14 trillion is not just money. $14 trillion is power. Structural power. Systemic power. The kind of power that doesn't need to be exercised loudly or publicly. It just exists. It surrounds the system. It permeates the system. It shapes outcomes through the sheer magnitude of its presence, and all of it flows through one company. A company founded in a single room in 1988 by 8 people who wanted to understand risk. A company whose CEO lost $100 million on mortgage bonds and decided to build a firm that would prevent that from happening again. A company whose founding philosophy was about understanding what could go wrong. That company is now managing 1/20th of global GDP. That company is advising central banks and governments. That company is deciding which bonds the Federal Reserve buys. That company is employing former government officials. That company is sitting on government advisory boards. That company has become effectively inseparable from the structure of American government. This was not the plan. This was not written into the founding documents. This was not the original vision. But this is what happened. This is what emerged over decades. This is what 3 crises and 2 bailouts created. The 2008 crisis created the initial precedent. BlackRock was hired to manage the Maiden Lane cleanup. BlackRock was hired to manage the AIG unwinding. BlackRock proved it could do the job. BlackRock became indispensable. The 2020 crisis reinforced the precedent. BlackRock was hired again for even larger sums. BlackRock benefited dramatically. BlackRock became even more indispensable. And in between, the revolving door accelerated. More government officials joined BlackRock. More BlackRock executives joined government boards. The boundary dissolved completely. This is not a conspiracy. This is not a secret plot. This is not something that's being hidden from the public. It's all public record. The SEC filings are public. The Treasury Advisory Board members are listed on government websites. The Federal Reserve Advisory Panel members are publicly disclosed. The announcements of government hires are public. It's all there. Anyone can find it. Anyone can read it. It's all transparent. But somehow the significance hasn't registered. Somehow people don't understand what they're looking at. They see the individual pieces. Oh, a former Fed official joined BlackRock, that happens all the time. But they don't see the pattern. They don't see the systematic nature of it. They don't understand that this is not normal. This concentration of power in a single private institution, wielding this much influence over government policy and financial markets simultaneously, is not normal. It is unprecedented. It is extraordinary. It is the defining feature of modern finance, and the timing is not a coincidence. The pattern matters. The structure matters. Remember, 2008, crisis comes, BlackRock hired, precedent set. 2012, economy recovers, politics normalize, the crisis fades. 2014, 2016, 2018, the system seems stable. 2020, crisis comes again, BlackRock hired again, pattern reinforced. And now we wait. We wait for the next crisis, because it will come. Crises always come. The financial system is cyclical, booms and busts, expansion and contraction. It's the rhythm of capitalism, and when the next crisis comes, the Federal Reserve will call BlackRock. It will have no choice. BlackRock will become more indispensable. BlackRock's power will increase. The boundary between BlackRock and government will dissolve further. The cycle will continue. This is the machine. This is how it perpetuates. This is how power concentrates. Each crisis makes BlackRock more essential. Each hiring of a government official makes BlackRock better connected. Each advisory board appointment makes BlackRock better positioned to influence policy. The system is self-reinforcing. The structure is self-strengthening. And it all happens within the bounds of law and regulation. Everything is legal. Everything is disclosed. Everything is public. And yet somehow the full picture doesn't come into focus for most people. But you're seeing it now. You're seeing the structure. You're seeing how the boundary between BlackRock and the United States government has dissolved. You're seeing how a private company founded in 1988 has become the most powerful financial institution in the world. You're seeing how concentrated power has become. You're seeing how a single firm, led by a single person, can transcend normal political boundaries because it has become too powerful, too important, too indispensable to be ignored. And this is only. There is more. So much more. There is the housing question. There are the trillion-dollar asset management contracts with sovereign nations. There are the 109 sovereign clients, central banks and governments that depend on BlackRock's Aladdin system. There are the implications for democracy and capitalism when power concentrates this way. There are the questions about what happens next. INC will explore all of that. We'll ask the questions that matter. We'll examine what it means that one private company has become effectively inseparable from the United States government. We'll ask what it means for your money, for your investments, for your financial future. We'll ask what it means for democracy when power concentrates this way. We'll ask what it means for the structure of capitalism itself. For now, let yourself understand this much. The boundary between BlackRock and government does not exist. It dissolved years ago. It was dissolved by crisis. It was dissolved by dependence. It was dissolved by the need for expertise that only one company possessed. And we are all living inside the consequences of that dissolution. Let yourself understand that. Let yourself feel the weight of that realization. Let yourself sit with the complexity of it. A private company has become inseparable from the government, and nobody voted for it. Nobody approved it. Nobody chose it. It just happened. It emerged from the structure of crisis and dependence and the concentration of expertise. Let yourself rest with that knowledge now. You are safe. You are warm. You are drifting into the next part of the story. But you are awake to the structure now. You can see it. You understand it. Let that knowledge rest with you as you drift away into sleep. And now we return to the story. You've learned how a $100 million loss became the foundation of a fortune. You've learned about Aladdin, the artificial intelligence system that monitors $25 trillion across 70 countries. You've learned that 3 firms, BlackRock, Vanguard, and State Street, own a piece of virtually every major company in America. But here's what keeps people awake at night. Here's what you need to know before you sleep. The system is bigger than the man, and the man doesn't answer to anyone. Let's start with a question people ask all the time. It's a confused, somewhat embarrassed question. People hear the name BlackRock and they think of houses, single-family homes. They've read the headlines. They've heard stories about Wall Street buying up neighborhoods. They think BlackRock is buying their neighbor's house to turn it into a rental. This is where the story gets subtle. This is where the real estate market tells you something about how power actually works. BlackRock does not buy single-family homes. That's important to state clearly. BlackRock is an asset manager, not a landlord. It doesn't operate as a property company. This is not the source of its power in housing. But here's what is true instead, and this is somehow worse. In the wake of the 2008 financial crisis, when millions of Americans lost their homes, institutional investors moved in. Blackstone, a completely different company but named confusingly similar, founded Invitation Homes. This wasn't a small operation. Invitation Homes became one of the largest institutional investors in single-family rental properties in America. They didn't buy dozens of houses. They didn't buy hundreds. They built a portfolio of tens of thousands of homes. Single-family homes that used to be owned by families are now owned by corporations. By 2022, large institutional investors collectively owned 574,000 single-family homes across America. Think about that number. 574,000 homes. Now here's the way people try to make you not worry about it. They say it's only 0.4% of all homes in America. They say it's only 3.8% of all single-family rentals. The numbers sound small. They want you to think the problem is tiny, but the concentration isn't spread evenly. It's not like institutional investors bought one home in every town. They bought clusters. They targeted specific markets, Sunbelt cities, Atlanta, Phoenix, Tampa. These are the markets where institutional capital flooded in, where a young family trying to buy their first home runs into competition from corporations with unlimited money, where rent begins to climb because corporate landlords aren't trying to maximize home ownership, they're trying to maximize cash flow. In Phoenix, between 2012 and 2020, institutional investors purchased approximately 15% of all single-family homes sold. 15%. In some neighborhoods, it was higher. The impact on housing prices was immediate and severe. Families that could have bought homes at $500,000 found themselves competing against corporate buyers with no emotion, no sentiment, no hesitation. Institutional investors don't worry about whether they can afford the mortgage. They don't worry about living in the neighborhood. They only care about the cash flow to rent ratio. If they can rent a home for $2,500 per month and the home cost $375,000, the math works. That home becomes a buy, and that home never becomes a place where a family builds equity. Atlanta saw similar patterns. Between 2020 and 2023, nearly 20% of all home purchases in some Atlanta neighborhoods were made by institutional investors. Corporate landlords are now the single largest category of new home purchases in major Sunbelt markets. This is historically unprecedented. For 100 years, American home ownership meant that a family bought a home, lived in it, improved it, and passed it to their children. That narrative is ending. That narrative is being replaced by a new one. A family rents a home, pays rent to a corporation, and never builds equity. BlackRock itself didn't have to buy the homes to transform the system. BlackRock built the capital flows. BlackRock created the financial infrastructure. BlackRock manages the money that flows into real estate investment trusts. BlackRock votes the proxy shares of the companies that own the homes. BlackRock's clients invest through BlackRock's funds in the real estate companies that own 574,000 homes. The system BlackRock built made it possible for institutional capital to reshape the housing market. BlackRock didn't need to own the homes. BlackRock needed to own the system. And it does. This matters because housing is how ordinary people build wealth. This is how someone moves from renting to ownership. This is how a family passes assets to the next generation. When institutional investors concentrate ownership in a market, they don't just own property, they own the future. They own the ability of an ordinary person to build equity in their own home, and they own the monthly cash flow from people who will never own what they live in. The system created this. BlackRock is the most sophisticated expression of this system, and the system is running smoothly while you sleep. Let's move from the homes people live in to the nations people live in. This is where the story becomes genuinely disorienting. BlackRock manages money for governments, not companies, governments. Not in the way a bank manages your checking account, in the way that a nation outsources the management of its sovereign wealth to a private American company. This is the official institutions group. This is the part of BlackRock that advises nations on how to invest the wealth of their people. 109 government clients, central banks, finance ministries, sovereign wealth funds. These are the institutions that manage the money of entire nations. They have collectively entrusted $579 billion to BlackRock, a private American company that was founded by a man who has never been elected by anyone, a private company whose executives have no accountability to any voter. This company advises governments on how to invest their treasures. The Saudi Arabia Public Investment Fund is the largest sovereign wealth fund in the world. It manages over $925 billion. This is the wealth of an entire nation. Saudi Arabia signed a memorandum with BlackRock to collaborate on investment strategy. $925 billion. And the strategy is being shaped by conversations with an American asset manager whose CEO's political influence flows through donations and dinners, not through democratic processes. In 2025, BlackRock announced a collaboration with the government of Paraná, Brazil. The state wanted to attract international investment. Who did they call? BlackRock, the largest asset manager in the world, a private American company. They called them to help shape the economic development of a Brazilian state. This is the normal course of business now. This is the system functioning exactly as it was designed to function. You live in a world where a private company advises the governments of nations on how to invest national wealth. This company answers to its shareholders, not to the people who live in those nations, not to the people whose tax money and national resources are being managed. Sovereignty is being outsourced. Democratic accountability is being transferred to a for-profit corporation. And the corporation is run by a man who has never faced a democratic election. Think about what this means. When a central bank makes a decision about interest rates, who are they talking to? When a sovereign wealth fund decides how to invest in a new market, who are they consulting? When a government's finance ministry plans for the future, who do they call? The answers are all the same: BlackRock, Aladdin, Larry Fink. The Brazilian state of Paraná has a population of 11 million people. It's a region that produces significant agricultural wealth, home to major agribusiness operations and manufacturing centres. In 2025, the government of Paraná wanted to attract international investment. They wanted to develop infrastructure. They wanted to create opportunity. Who did they call to advise them on how to do this? A private American company run by a man who has never been elected by any Brazilian citizen. A company that stands to profit from whatever investment strategy is implemented. A company that serves as both advisor and investor. This is the normal course of business in the modern world. When Saudi Arabia's public investment fund makes a major allocation decision, the conversations happen with BlackRock executives. When a central bank in any of 70 countries needs to stress test its portfolio, it uses Aladdin. When a finance ministry wants to understand how geopolitical risk might affect its reserves, it consults with the company that monitors global financial flows better than any government does. The nation-states of the world have outsourced their financial thinking to a private company. This creates a particular kind of dependency. Once you've made a decision with a consultant, it becomes harder to reverse that decision without consulting them again. Once you've shared your financial information with an advisor, you need their approval to do things differently. Once you've built your investment strategy with someone, changing that strategy means admitting the previous strategy was wrong. The dependency deepens with every decision made together. And BlackRock has made more financial decisions with more nations than any other advisor in human history. The money flows through the night while you sleep. Decisions are made about the wealth of nations, and you didn't vote for any of it. You didn't authorize any of it. It's happening in a sphere that democracy stopped watching a long time ago. Now let's talk about the money that ordinary people invest. We need to talk about index funds. We need to talk about the passive revolution. This is the moment where the system found a way to move trillions of dollars from individual investors into the hands of 3 corporations without anyone realizing what was happening. It started with a simple idea. If you can't beat the market, why try? Why pay a fund manager 20% of your gains when you could just buy the entire market? Buy an index. Match the market. Let the fees be tiny. It was a democratic idea, investing for everyone. No fancy footwork, no hidden costs. Just you, a low-cost fund, and the entire economy. It was a beautiful idea. And it worked exactly as intended. Hundreds of billions of dollars poured into index funds. Then hundreds of billions became trillions. Now index funds are the largest single category of investment in America. The passive revolution was a revolt against high-cost active managers. It seemed like a triumph for ordinary investors. Lower costs, better transparency, democracy in the markets. But here's what happened. All those trillions of dollars went to 3 places: BlackRock, Vanguard, and State Street, the big 3. They control 74% of the ETF market. They control 80% of all index funds. $5.1 trillion flows through BlackRock's iShares ETFs alone. $5.1 trillion. That's roughly equal to the entire annual economic output of the United Kingdom. The entire economy of the United Kingdom gets replicated in ETF assets managed by a single company. When someone buys an S&P 500 index fund, they think they're making a passive choice. They think they're just matching the market. They think they're staying out of corporate politics. They think they're being neutral, but they're not. Their money is flowing to BlackRock, and BlackRock is using that money to vote. BlackRock is using that money to influence. BlackRock is using that money to shape the decisions of the companies inside that index. The passive revolution accidentally created the most concentrated voting power in the history of markets. An investor who owns one S&P 500 index fund is giving their voting power to 3 companies. The votes in those companies are being cast by people the investor has never met. In meetings the investor doesn't attend, according to criteria the investor didn't set. The investors think they're making a passive choice. They're actually participating in a system where their collective power has been consolidated and delegated to a small group of unelected officials. $5.1 trillion. Think about what that money's doing right now. It's being deployed. It's being tracked. It's flowing into dividends and buybacks. It's voting in corporate shareholder meetings. It's casting 1/4 of all votes in the S&P 500, and it's all being managed by people who didn't ask for your permission. You gave your permission by buying a fund. They used that permission to consolidate power that you didn't understand you were giving. The most beautiful part of the system is that everyone involved can justify it. The investors think they're paying lower fees. The fund managers think they're being more efficient. The corporations think the votes are legitimate because they're coming from shareholders. Everyone involved can look at the system and see a rational actor behaving reasonably. And somehow, remarkably, all those reasonable actors have created a concentration of power that would make medieval kings jealous. Consider what happens when you buy an index fund. You go to your broker. You type in a ticker symbol like SPY or VTI. You click buy. $30 is deducted from your account. The transaction takes seconds. You have just delegated voting power over dozens of major corporations to a company you've never met. You have just contributed your capital to a fund that will use it to vote in shareholders' meetings you don't attend. You have just empowered someone you've never spoken to, cast votes that will shape the direction of the companies that employ millions of people. This happens millions of times per day. Millions of individual investors making passive choices that collectively create massive concentrated power. Each individual investor is making a rational choice. Lower fees, diversification, simplicity. Each individual choice is rational. But the collective result is that voting power over corporate America has been consolidated in 3 firms. Here's what this means in practice. Imagine there's a shareholder vote at Microsoft about a new corporate policy. Millions of Microsoft shareholders will vote, but $205 billion of Microsoft stock is held by BlackRock. The votes tied to that $205 billion go to BlackRock executives. Maybe not to Larry Fink himself. Maybe to someone who works for him. But the power to cast those votes sits with BlackRock. If the proposed policy has BlackRock's support, it likely passes. If BlackRock opposes it, it likely fails. This happens not because BlackRock secretly rules the world. This happens because millions of investors made passive choices that consolidated voting power. This happens because the system is designed to concentrate power, while everyone involved is making individually rational decisions. The system doesn't need anyone to be evil. It just needs everyone to be reasonable. And therein lies the true genius of the system. It feels normal, it feels efficient, it feels fair, and it works in service of massive, unimaginable concentration of power. This is the infrastructure of modern capitalism. This is what it looks like when systems consolidate power through efficiency rather than through conspiracy. Let's talk about 2023. Let's talk about the moment when the system's fragility became visible for a few terrifying weeks. Silicon Valley Bank collapsed in March 2023. It was an absurd collapse. SVB wasn't a complicated bank. It wasn't corrupted by subprime mortgage schemes. It wasn't caught in an exotic derivatives trade. It did something much simpler. It invested heavily in US Treasuries when interest rates were near zero. Then the Federal Reserve raised interest rates. The value of those Treasury holdings dropped. The bank had massive unrealized losses. A few large depositors panicked. Withdrawals spiked. The bank didn't have enough cash. It failed. On the same day that SVB collapsed, Signature Bank also failed. Cryptocurrency exposure. Different problem. Same result. The banking system looked fragile. The system that moves trillions of dollars every day suddenly looked uncertain. The Federal Reserve had to act. It had to restore confidence. It had to prevent a cascade of bank failures that could trigger a financial crisis. So what did the Fed do? It called BlackRock, again. The Fed called BlackRock, again. BlackRock was brought in to advise on the emergency sale of assets from SVB and Signature Bank. $114 billion in assets needed to be sold. BlackRock did the work. It wasn't a small contract. It was a massive undertaking, and the Federal Reserve gave it to the company that already knew the financial system better than anyone else. The company that had handled the 2008 crisis. The company that had handled the 2020 crisis. The company that the government trusts to manage its most critical moments. Pro bono work, they called it. BlackRock wasn't charging its usual fees. The company was helping the government in a moment of crisis. It was patriotic. It was civic-minded. It was also an opportunity to reinforce the relationship between BlackRock and the Federal Reserve. It was an opportunity to prove that when the system breaks, the Fed knows exactly who to call. But here's what people missed. While BlackRock was doing pro bono work for the government, its own assets were surging. Investors were fleeing to safety. Where does a frightened investor go? To the largest and most stable asset manager in the world, to BlackRock. As individual investors panicked about SVB and other regional banks, they pulled money out and put it into BlackRock funds. BlackRock's assets grew by tens of billions, while it was publicly claiming to serve the government at no cost. The firm was simultaneously advising the government on how to contain the crisis, while the very crisis drove investors into BlackRock's own funds. This is what modern conflicts of interest look like. Not bribery, not corruption, just simultaneous alignment of interests. BlackRock helps the government manage the crisis. BlackRock profits from the crisis. Both things are true at the same time. The pattern is undeniable now. 2008, the Fed hires BlackRock. The firm becomes essential to managing the collapse of the mortgage market. 2020, the Fed hires BlackRock again. The firm becomes essential to managing the Fed's $1 trillion emergency stimulus. 2023, the Fed hires BlackRock again. The firm becomes essential to managing a regional banking crisis. 3 crises separated by years. 3 times BlackRock becomes essential to the government's response. 3 times the government becomes more dependent on BlackRock's expertise. 3 times the boundary between BlackRock and government becomes blurrier. 3 times BlackRock's position as the central node of global finance becomes more entrenched. Every time the financial system breaks, the call goes to the same place. This creates a particular kind of power, not the power to rule, but the power to be indispensable, the power to be trusted in moments of panic, the power to shape how governments respond to their own crises, and the power to become more entrenched each time the system breaks. The system is breaking more often now. Financial stress is becoming normalized. Market volatility is routine, and every time something breaks, the same company is there to fix it. The company whose interests often align with the government's in those moments. The company that is simultaneously helping the government while managing trillions of dollars for private investors. The company that's getting richer while helping solve the crisis. The company that's becoming more essential. This is how power consolidates in modern systems, not through force, through indispensability, through being the one institution that governments can't afford to say no to when everything's breaking, and everything is breaking more often. Now let's step back and ask the bigger question, the question that's been implied throughout this entire narrative. What does it actually mean that a single private company manages more money than most nations produce? The annual economic output of the United States is approximately $28 trillion. BlackRock manages $14 trillion. That's 50% of US GDP. That's more than the entire annual economic production of the United States being managed by a single corporation. And that's just BlackRock. The big 3 manage $26 trillion combined. That's roughly equivalent to the entire economic output of China and the United States combined. 2 nations with billions of people combined produce roughly the same amount of economic value annually as 3 asset management companies produce in cash flows. These comparisons can start to feel abstract. So let me make it concrete. Every major technology company in the world has BlackRock as a significant shareholder. Every bank, every pharmaceutical company, every energy company, every retailer, every telecommunications company. BlackRock owns a piece of everything. And when BlackRock owns a piece of everything, it doesn't just own capital. It owns influence. It owns access. It owns the ability to shape the direction of corporate governance across the entire economy. When a technology company wants to hire a new CEO, it needs the board to approve the appointment. BlackRock votes on that board. When a company wants to launch a new strategic initiative, the board has to approve it. BlackRock votes on that board. When a company wants to change its dividend policy, the board decides. BlackRock votes. When a company wants to enter a new market or exit an old one, the board approves. BlackRock votes. When a company wants to change its executive compensation, The board approves. BlackRock votes. This isn't direct control, but its influence so pervasive that it might as well be. The proxy votes of BlackRock can determine the outcomes of corporate contests. A CEO who loses BlackRock's support has a very difficult time. A strategic direction that loses BlackRock's backing doesn't happen. Now combine this with what we know about Aladdin, the AI system that monitors $25 trillion. The system that has visibility into the investment strategies and portfolio holdings of the largest institutional investors in the world. The system that knows what money is flowing where. The system that knows what banks are struggling before the government does. The system that can model the outcomes of various economic scenarios with mathematical precision. Think about what Aladdin knows. It knows that a particular regional bank has treasury holdings worth $1 billion. Aladdin can calculate how much value that bank has lost if interest rates rise. Aladdin knows that the bank has deposits of $1.8 billion. Aladdin can model the probability that a certain percentage of those deposits will be withdrawn if confidence begins to crack. Aladdin knows which institutional investors are starting to pull money out. Aladdin knows which banks are experiencing unusual outflows. Aladdin knows which sectors are about to face stress. Aladdin can see the entire financial system in real time, understand the connections, and predict where the system is most fragile. This information is worth billions of dollars. No government has information this good. No bank has information this complete. No competitor has visibility into global financial flows like BlackRock does through Aladdin. The system that was built to help manage risk has evolved into a system that gives BlackRock visibility into the entire financial world. BlackRock knows when the system is about to break before the system breaks. BlackRock knows which institutions are vulnerable. BlackRock knows which markets are about to implode. And when the government needs to prevent a financial crisis, the government calls the only company with information this good. What happens when the company that votes the shares in corporate America also has the information system that monitors global finance? What happens when the company that manages government crises also manages the money of foreign governments? What happens when the company that advises corporations on governance also trades in the securities of those corporations? Consider a hypothetical scenario. BlackRock's analysts using Aladdin realize that a particular sector is about to face serious headwinds. Perhaps interest rate increases will hurt financial companies. Perhaps changes in consumer behavior will hurt retail companies. Perhaps new regulations will hurt technology companies. BlackRock knows this before the market knows it. BlackRock can position its own funds to profit from this knowledge. BlackRock can adjust the portfolio holdings of its clients' funds. But BlackRock also votes the shares of those companies. BlackRock can vote in ways that signal confidence or signal concern. BlackRock can vote in ways that help shape the narrative about the company, and BlackRock profits from being right about the sector. This isn't illegal, but it's a conflict of interest so profound that it barely qualifies as a conflict anymore. It's just the normal course of business. Or consider this. BlackRock's money flows into a particular company. BlackRock votes at that company's shareholder meetings. BlackRock uses its voting power to push for strategic directions that BlackRock believes will be profitable. The company moves in that direction. The stock price rises. BlackRock's holdings are worth more. BlackRock's clients benefit. The cycle continues. This is legal. It's how fiduciary duty is supposed to work. But when BlackRock's voting power is so concentrated that it determines the outcome of shareholder votes, the incentives become twisted. BlackRock doesn't need to persuade other shareholders. BlackRock just needs to vote its own holdings and win. BlackRock's fiduciary duty to act in its client's best interest has become a duty to act in ways that make BlackRock's voting power more valuable. You get a conflict of interest so large that it becomes invisible. It's too big to see. The system is too integrated. The conflicts are too numerous to count. So we just accept them. We accept that companies doing business with the government are also managing government crises. We accept that companies voting in shareholder meetings also trade in those companies' securities. We accept that companies with fiduciary duties to their clients also have conflicts so profound that they can't be disentangled. We accept them because the alternative is impossible. Breaking up BlackRock would mean destroying the infrastructure that keeps the financial system functioning. This is the infrastructure of modern power. It's not the power to rule, in the traditional sense. It's the power to be involved in every transaction. It's the power to collect information about every major financial decision. It's the power to vote in every significant corporate governance decision. It's the power to advise governments on how to manage their own crises. It's the power to profit from the system while simultaneously maintaining the system. One man created this. One man in a single room in 1988 decided that the world needed better risk management. 35 years later, that one man has shaped the financial infrastructure of the entire planet. He has done this without being elected. He has done this without being voted into power by anyone. He has done this simply by building a company that became so essential, so integrated, so profitable, that governments and corporations stopped asking whether this was the arrangement they wanted. Larry Fink is not a politician. He doesn't run for office. He doesn't answer to voters. He doesn't appear on ballots. And yet he has more influence over economic policy than most politicians do. His letters to corporate executives are read carefully. His opinions on climate change, on social issues, on corporate governance have shaped corporate policy across the entire economy. His company advises governments on how to manage national wealth. His system monitors global finance with precision that governments can't match. And he exercises all of this power through persuasion, through the ownership of capital, through the control of information. His power is more durable than political power because it doesn't depend on elections. His power is more extensive than political power because it spans borders and jurisdictions. His power is more subtle than political power because it operates through systems and incentives rather than through laws and coercion. And none of this is illegal. All of this is the natural evolution of capitalism. All of this happens within the framework of existing rules. It's just that the rules were written for a different world, a world in which no single company would become this large, this integrated, this essential. The rules assumed that competition would prevent concentration. The rules assumed that markets would self-regulate. The rules assumed that if one company got too powerful, other companies would challenge it. The rules were wrong about all of that. This is what it looks like when power is concentrated so completely that people stop noticing it's concentrated. This is what it looks like when one person's vision becomes the infrastructure for everyone else's financial lives. But here's the thing you need to understand. The man is not the cause. The man is the symptom. The system created BlackRock. The system of passive index investing created the need for a manager of trillions.